I'm going to do an Equity Accelerator actual loan example. This is for a purchase. The term is 1 month adjustable. It's a margin of 3.25. The current SOFR index, which is what it's based on monthly for the changes, is 3.652. And the interest rate, the starting rate, would be 6.902. The estimated home value we're using is $675. The loan amount, 80% loan to value, is $540,000. But the initial draw, they want only 99% of the line value. So you're really putting 81% or 79%. That's the initial draw. We are going to compare 30-year fixed with the other loan. So next, I'm hitting continue, and we're going to do deposits. So this is a couple, and the one couple, their actual take-home pay is $2,875 bi-weekly, which is 26 times a year. Whereas the other spouse, it's take-home pay of $3,128, but it's twice a month, the 15th and the 30th, or 1st and 15th, 24 times a year. Now, future deposits, this is a condo that they can rent out, but they also want to use it for themselves. So we have them using it for the first 7 months themselves, but 8 months is peak rental season around here, and they can easily get $10,000 in that month. The next month, same thing, and the month after that. 3 months in season is ideal for a conservative amount of rentals in Marco Island or Naples, Florida. Then we're also going to have the next year. You get a little bit more, month 20, month 21, 22, and it continues down like that. My screen is acting up. I apologize. So we have it for 3 years. So month 34, they're getting $12,000. So 11 the second year and 12 the third year. Then we're going to continue, and we're going to look at their actual itemized expenses. Their car payment, $790 a month. I took everything from their credit report minus the car payment, because that depends on how long you have left on the car payment if you get a new one. So everything else on their credit card or on their credit report was $4,737. And the property taxes and insurance for the second home that they're purchasing, which is a condo, is $600 a month. Then finally, we can do some advanced calculations, like what if the interest rate goes up, and show all the rates, different things. But right now we're just using the standard. So when we look at this, the Equity Accelerator pays off in 8 years compared to a traditional 30-year fixed loan at 7% interest, pays off in 30 years. It's the same total principal, but the amount of interest paid on the accelerator loan is dramatically less than the interest paid on a traditional 30-year fixed. You're only making 91 payments if you continue with the income and expenses as currently shown. Now, the reason is because all of your income lowers the principal balance, which lowers your interest payment. Where a traditional loan, it lowers the interest first and it's on a set schedule. So unless you're adding additional payments, it's going to stay at this total expense for a loan of $534,600. You're spending over $1 million total. Where is if you do the Equity Accelerator, you're not spending hardly anything over the principal, and then you're spending a quarter of that for interest. So with the Wealth Builder, the Equity Accelerator, your payoff is 22.4 years faster, and your savings is over $500,000. And at 24 months, you have $151,854 in equity compared to a traditional loan where the first 24 months, most of what you're paying is interest and hardly any equity is being built. So if we look further at that, principal reduction is 13% annually versus a traditional mortgage is only 3% annually. And the portion of interest of your principal amount on the Equity Accelerator is 26%, whereas with the traditional loan, it's 140%. So you're paying more in interest than you're taking out on the loan. We can print this out. We can also show a comparison schedule. For example, it's a great program. I hope this actual situation helps you understand a little bit about the Equity Accelerator. I needed to update from my old one. Please be sure to hit and subscribe on my YouTube channel to see other videos of home tips and tricks. Thank you.